Welcome back, everybody, to another episode of Take Back Control Tuesday. Now, I can't tell you what the outcome is going to be for each and every one of you, but what I can tell you is for the next hour and 40 minutes, the time we're going to spend together, if you apply what you learn, this will change your financial future. If you're here, that means you're ready for change. And tonight, that's exactly what we're gonna deliver. I've got a special guest for you. His name's Jason Sipple. He is a master of what you're gonna learn. But what are you going to learn? Well, Jason is gonna teach you three things. He's gonna teach you how to take back control of your money by being your own bank. And then he's also gonna teach you how to build wealth through your own debts and expenses. That'll be the second thing you learn. And the third thing you'll learn, hence the cars, you're gonna learn how to get all the money back for every single car that you ever buy, drive, and own. And before you get into it, one last favor, just click that button right there, the subscribe button. It would do me a huge favor. And also, right above is a little bell. Smash that bell so that every time I put new content out, you'll be notified. So I don't want to waste any more time. It's time for Jason to really show you all about the infinite banking concepts. Let's roll.
Take back control.
Tuesday night.
Tuesday? What if by changing one thing, you could change everything would be better financially for your family? Would you make that one change to be financially free? That one paradigm shift is the new skill, is the gap between you and the wealthiest families. And who here, show of eyes in the chat, wants more money? Who here wants more control? And who here wants freedom, like William Wallace? So I'm going to let you in on a little known fact. The wealthiest families and visionaries like the Rockefellers and Walt Disney have been using a strategy called infinite banking for ages to build and preserve their empires. And the strategy is simple, legal, and it's something that you all have access to. Isn't that crazy? And it all starts with just changing one thing. You got to start loving yourself a little bit more. Start paying yourself first. Shockingly, we're giving away a big chunk of our money every time we get paid to the bank, to the government, and to Wall Street. And do you all want to know how you can recapture and recycle, bringing all that money back into your family? And it all starts with one simple change. Where does your money go first? So get ready as we dive into the infinite banking process where you can make money with every car you ever buy, own, and drive. We'll uncover how you can turn your debts into assets, how the banks make their fortune, the definition of money, and why success leaves clues. Like Tony Robbins says, how can you apply the clues left for you? I thought this was unbelievable, even to someone like me who had a family, worked a 9-to-5, but now I'm on my own as an entrepreneur. And trust me, once you see how simple this concept is, you'll realize that there is a future of financial freedom for you and your family. We're going to go through those real life examples, show real world applications, real client examples that you can do right now, today, and put you in a position of wealth creation. You might think this is unattainable, but I promise you, it's well within your grasp to have it. My only request is you keep an open mind, and anything you don't know, just tell yourself, I just don't know this yet. ... So let's jump in. Let's get started. And so now I want you all to close your eyes. This is going to be a presentation of faith, of logic, of intention, and of having a long-term vision. So close your eyes. I want you all to imagine that you're in a room with 100 new grad, 17, 18-year-old high school students. And I'm going to ask them a question. I'm going to say, hey, who here is going to be successful by the time you reach retirement? Now, they're going to jump up out of their chairs and they're going to be all saying, me, I'm going to be the next billionaire, the next Bill Gates, the next Warren Buffett, the next Elon. believe they're going to be wildly, wildly successful. Do you all remember how you felt back when everything was possible? Back when you knew hardly anything, but you believed in yourself. You believed that you were going to be successful. But then something changes. It's slow, it's over time, it's insidious. Something changes, and only one of 5 of these 100 high school students are going to be wealthy. Only 5 out of the 100 are going to be financially free, financially secure. And how can that be? We live in the greatest country in the world, at the greatest time in the world, the greatest technological time in the world. How is that possible? How's it possible? Just ask yourself that question. How can that be possible? And look at this shocking statistic from the Social Security Administration. 5 out of 100 people will be financially secure by retirement age. Now, for me, retirement is made up. It's really about cash flow, passive income, but that's a whole different topic. But this stat is shocking. This stat is shocking. Like I said, we live in the most powerful nation in the world and the best time in the world to create. And the difference is between being someone that reaches financial security and someone that stays stuck in the rat race is a simple shift. It's a simple change of that one thing. And that one thing is going to change everything. It's very much like this very impactful quote where Will Rogers said, the problem in America isn't what people don't know, it's what people think they know that just ain't so. Speak the truth, Will. That is the truth. It's not what people don't know. It's what people think they know. It's the pattern that they've prescribed to. It is the taking on the risk. It is the taking on all of the financial doubt and worry and fear that others have taught you. So let's jump into this. First, though, let me tell you who I am. Why am I here? Why do I get to present to you on Take Back Control Tuesday about this infinite banking concept? Well, it's because I ran away from money my whole adult life. It scared me. Anyone here identify with that? It freaked me out. When I heard people talk about money, I heard Charlie Brown's teacher doing the wah, 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 wah. When my friends were talking about money and investments and the things that they were going to buy and dreams, I was like, can we talk about anything else? Anything. Cars, girls, riding bikes, whatever, just other things than money. And a few years ago, when I was helping other people reach their dreams in peak performance coaching, I was standing there at a mastermind in Mahwah, New Jersey. And the guy who was the leader, and I was one of his team, right? One of the coaches. And he was asking people like just like those 18-year-olds, who here believes they're going to be successful? How much money are you going to have? What are you going to have? Who are you going to be when you achieve that success? What is the journey going to look like? Who have you become? Who are you around? Where do you live? How much money do you have? Millions, billions, whatever your goal is. How much are you giving away? And I broke down and I started crying. And I just looked around the room and I was like, this isn't my dream. I'm building a dream for someone else, which I've done, in corporate America as well. But I realized in that moment that working 18 hours a day, 7 days a week, even though I was making impact in those people's lives and serving at a really high level, my family was being let down. I was being let down. And I started crying, and it was awful. Like, this is 4+ years ago now, and it's still to this day. I can feel it in my being how sad and lost I was. And I went and I asked my friend for a financial philosophy, and he handed me a book, which I'm going to show you on the next page. But he handed me a book that changed my life. When I understood my human nature and the things that could perhaps throw me off course and had for my whole life, my money rules, and also when he showed me the game. It's very much like Einstein says, first, you have to know the rules of the game. And then what do you have to do? You have to be able to play better than anyone else. first you got to know the rules. Ask yourself, if you're here, you may already know the rules if you're practicing, but if you're new here, hold space. Maybe you don't know the rules of the game. So let's look at some of the truths around money. Well, first, I lied. First, let's look at who's written about this before. Let's look about who has already talked about this, because this is out there. The infinite banking concept has been around for a while now, and it's been used by the wealthiest families. But this guy, you guys know him, he wrote Rich Dad, Poor Dad. He had a rich dad and a poor dad. And Second Chance, Robert Kiyosaki talks about the infinite banking concept, or using permanent life insurance. Tony Robbins talks about it in Money to Master the Game in section 5.2. Then you have the book I was mentioning, this book. You have Chris Naugle, that's next, but you have this, Becoming Your Own Banker by R. Nelson Nash. If you don't own this book, if you haven't read this book, it is a must for everyone's financial library. It should be right next to your Bible. Look, it's giant font. Some of the pages don't even have more than 2 paragraphs, so it's 91 pages. You could read it in a day, even if you hate reading. And then you have Mapping Out the Millionaire Mystery. That's my partners, Chris Naugle, Brent Kessler. Amazing book talking about their personal journey, because you have to find people who have been there, had the success for you to model. And Chris also wrote, brilliantly so, the Private Money Guide, because he understands that, hey, if you're going to take back the banking function in your life, bring back banking to the you and me level, first, you must understand how to move money, because money in motion makes more money. So that's a thought that you can write down as well. Now let's talk about an interesting concept. How many of you have seen this backwards bicycle before? Pop it in the chat if you've seen this before. But it's an intriguing concept, and I want you to think about this. Who learns quickly, or who learns fast? Our kids, right? Our kids and our grandkids. They learn so fast. Think about the first time you taught your kid how to ride, or the first time maybe you learned how to ride a bike. What do? You press down the pedals, the bike moves forward, right? You turn the handlebars to the right, the bike goes right. You turn the handlebars to the left, and the bike goes left. Super easy. Now, you might have fell down a couple times. You probably scraped your arm, maybe bumped your head, scraped your knee. But what'd you do? You got back up and you did it again. And the kids do it again. And eventually it's freedom. They are flying. They're going everywhere. They're jumping off of things. They're going down big hills and scaring us half to death. But they learn really quickly. What if it didn't work like that? What if you got on the bicycle? Who here thinks they could ride a bike that didn't work like that? If you turn the handlebars to the right, the bike goes left. If you turn the handlebars to the left, the bike goes right. Anybody think they could ride it? I think I could ride it. I ride my bike a couple times a week. I just rode 106 miles this past weekend, and it was my 4th gravel ride ever. My longest before that was 45 miles. So my ego says I could, but I bet you I would fall down. I would learn that, hey, I can't do this yet, and I would try again. What if money is exactly like that? What if everything you know about money isn't true? What if it doesn't work the way that you think it does? Just hold space, because I'm going to jump into that in a moment. But when you have time, go look this up on YouTube, watch the backwards bicycle, watch what this welder did to the engineering team, and watch how these patterns in our mind, how these grooves can become like a well-worn path that we're stuck in. And it takes a lot to break that. It takes a lot of courage. It takes a lot of thought, attention, and really understanding where you're going. So let's jump into some of the reasons why more people aren't more successful. Okay? These are the wealth killers. And we talk about these every day here. We talk about these every day. But I'll just ask you these in a different way. Do you guys know what your taxes are going to be when you retire, or when you get to retirement age? Do you know if they're going to go up or down? Talk about this again, but no. So taxes are a huge wealth killer, and they're also an unknown thing in the future. Inflation. Think about how much eggs and gas cost today compared to just a few years ago. It's pretty crazy. Volatility, the market going up and down. Now today wasn't a great day in the market. It's down quite a bit. So when we have our money tied to something where we don't know if it's going to go up or down, that volatility can be a wealth killer. and then giving away interest to other parties. Because the fact is, we finance everything. And some of you might say, hold up, Jason, I don't finance everything. I pay cash. Okay. Well, that's the third way that you finance things. And that means you've given up the opportunity of that cash to earn you money for the rest of your life. Or you earn interest or you pay interest. Those are the only three ways that you can buy anything, unless you're bartering, trading chickens and goats and things like that. But you purchase things, you have to finance everything. Earn interest, pay interest, or give up the opportunity to earn interest. And then the mindset. My big focus is always between the ears, the most valuable real estate that you have in the world. And that's, following the status quo, the fear of failure, the fear of rejection, the fear of things not working out, the fear of going against what everybody else is doing. And this is where people really get stuck. Jason, if this was so good, why isn't everybody doing it? This feels too good to be true. I get that all the time. And then I get once someone starts, well, Jason, I wish I would have started this or knew about this 5 years ago, 10 years ago, 20 years ago. Of course, that's how we all think once we realize that something is true. But when it feels too good to be true, no one else is doing it. The one question I'll leave you with, and I've never said this in this training before, is when you look at your financial picture, when you look at how you are financing things, your lines of credits, the different things you're using, who's benefiting the most? Yes, you might have the thing, but who's earning money and who has the most money to make to earn interest off of us if we're using the current financial system? Is it you or is it someone else? Is it the banks, the government, Wall Street, the evil empire, as we like to joke around? Let's look at some of these mysteries of money. Let's ask some fundamental questions around money. First, let's start with an easy one. What's the definition of money? What's the definition of money? What's your definition of money? And let's come up with a common definition, because we might all have different definitions. Before he says a means of exchange. Bingo, that's it. Well done. It's nothing more than a means of exchange. You pay money for house, house for money, money for car, car for money, money for food, food for money. It's a means of exchange. It is just value being exchanged, and it's easier, like I joked around earlier, to trade money, to trade dollar bills than it is to trade chickens and cows and things of that nature. What company uses compound interest? And you guys are thinking, ooh, I know, Jason, call me. It's the banks. Well, not necessarily. The banks don't earn compound interest. They might pay you interest, but the banks, as soon as you deposit your money there, is that a liability or an asset to the bank? Well, I'm going to show you how it's a liability, because they have to guarantee paying you at least that 0.07% in the savings account, or whatever the paltry amount, or if you have your money in a high yield, whatever that account is. And this is something we'll talk about more as well. Are your dollars worth more today or in the future? For some reason, this stumps a lot of people. So think about when you were a kid. Think about how much a candy bar cost. How many candy bars could you buy with $1 when you were a kid? If you put like 2 or more, well, then I know that you're like my age. If you put more than that, then you're older. If you put less than that, then you're younger, right? It's a nice gauge of age, but your dollars are worth more today than they will be in the future. And they're worth more yesterday than they are today. Because today, with $1, you can't even buy a single candy bar. Taxes in the future, are they going up? Are they going down? I do not have a crystal ball, but if you guys want to get freaked out, go to usdebtclock.org, look at that. We're over, I think last time I checked, $36 trillion in debt. We should be another $10 trillion in debt within another year or so. That's crazy. So how is the government, who doesn't earn money, going to pay for this in the future? Taxes. They're either going up or they're taxing more things. There's not another way. And what do you guys all know about your retirement account? You know that you might be getting a match. You might be getting a match up to a certain point, which is awesome. But the reality is, if you think about your retirement account, let me ask you 4 questions, and please write these down if you want. Do you know when you're going to die? I'm sorry If that ruined it for anybody and you didn't know you were going to pass away at some point, we're not going to be here. We're going to graduate, as we like to say. But do you know when you're going to die? The answer is no, we don't. Maybe you have a rough idea from parents, grandparents, and history, but you don't know for sure. You don't know when our time and God is calling our number, right? Do you know what taxes are going to be in the future? No, we don't know what they're going to be. Most likely they're going up, but we don't know that for a fact. Do we know what inflation is going to be in the future? Nope, we don't know that either. Okay, do you know if the market's going to be up or down when you leave your position, when you leave your job, when you want to take your retirement? No, that's 4 variables. 4 variables you don't know. So unless you're really involved with your retirement account, I would ask you, maybe there's a better way. Maybe there's a better way, and stop giving Uncle Sam, who is your partner, whether you know it or not, your money for the future. And again, I'm not a financial advisor. I'm just saying, let's think a little bit differently. So these things might have made you uncomfortable. They might have made you go, I wonder what Jason's talking about. Maybe he's on to something. And maybe this is going to open your mind and leave space for that paradigm shift that we talked about in the beginning of changing just one thing. So what is the money multiplier method? We like to keep things simple here. We like to keep things in 3s when we can. So let's look at this method. First, we're going to have the machine. And I've already talked about it, gave hints to it, talked about the nature of permanent life insurance, right? That's what we're talking about, your whole life. So the machine, okay? And we're going to talk more about the machine and dive in and look under the hood. Next, we're going to talk about the marathon. You guys know anything about me? I don't run a marathon unless I've ridden my bike at least 112 miles. Well, that's not true. Once I ran a marathon and I was slower than Oprah, but later when I became an Ironman athlete, it's about that long-term thinking. It's about knowing where you're going in the long term. And we're talking about decades and centuries, your kids, your grandkids, what that future looks like. And now we are, as humans, we haven't evolved to think of our future selves. Like you can study the work of Dr. Benjamin Hardy, be your future self now. That space that you create to think about what you want, where you're going, who you want to be, that's a magical place. Because once you see it in your mind, once you know where you're going, then you can get there. Then you have a destination. So the marathon, this isn't a get rich quick scheme. This is a marathon. This is something that is applicable to every single person here. It's just a matter of meeting you where you're at today with your knowledge and your finances. And finally, the millionaire. How many here want to be millionaires? Like that is a goal of mine. That is something that will happen in the not so distant future. But first I had to believe it. It took me a long time to map out that millionaire mindset and that millionaire path. Maybe you don't want to be a millionaire. Maybe you want to be a multimillionaire. Maybe you want to be a billionaire. Whatever you want is up to you. That is your journey. And so let's look at the machine. What is this machine, Jason? I already told you. You guys remember? Look at all the millionaires here. I love it. It is nothing more than dividend paying whole life insurance policy from a mutually owned company. Wow, is that a letdown to anybody? Was anybody expecting something really exciting? No, it's permanent whole life. The first thing we're doing is we're applying to be an owner with a mutually owned company. Why mutually owned? Because in a stock-owned company, are you number one? No, the stockholder is. They're trying to get the dividends for the stockholders. So you want a mutually owned company, preferably one that's been around and profitable for over 100 years, 100 plus. And that's all of our partners. They've been profitable every year. And you want to make sure that they are mutually owned again. And you want to make sure that we're not talking about indexed universal life. We're not talking about the VULs. We're not talking about the ULs, right? No variable universal lives, no universal lives, no term. As an infinite banking certified Nelson Nash practitioner, anyone that's a money mentor that is that certified practitioner can never give you an IUL for banking. Why is that? Because it's not in your favor. It has too much variability being tied to the market, and it has unknowns. So I'm not going to dive deep into it. There's plenty of material out there about why it doesn't work. And I've talked to hundreds of folks. I have one guy surrendering his policies to get into a convertible whole life so he can protect his family, to guarantee it, to change it to whole life when he's ready financially. But he's giving up, I want to say $6,000 or $7,000 of surrender money to the life insurance company to get out of these 3 or 4-year-old IULs. That was a conversation I had yesterday. So we're not for banking talking about IULs ever. Just puts you in too much risk. And you guys don't need more risk in your financial life. So let's do this fun exercise I do every day. Grab your pens and paper, grab your crayons, grab your markers, draw yourself a T-chart, draw yourself a cross, okay? In the top right, you're gonna write bank. In the top left bank, top right policy. And we're gonna go through this line by line. This is interactive, so I need you guys to participate in the chat, participate down below. Under bank, under policy, write the word liquid or liquidity. Please define the word liquid in your vocabulary. What does that mean to you? Going once, going twice. It means that, like you said right there, that the money is accessible. It is not locked up in financial prison. As Lee said, you can move it. You have access to it. It's not someplace where you got to pay a penalty to get it. That's not stuck in your qualified plan until you're 59 and a half, and you're penalized to use it and all those things. Now, here's the one where I need you guys to participate. Who here has a high yield savings? If you do, I know the rates have been coming down, but put what you're currently getting. Maybe you have one of the online banks for the high yield. Put what your percentage is, because I want you guys to have this apples to apples for yourself. Nancy says she has one. So write whatever yours is. I've seen 3.5%. I've seen 4%, 3.8%. Thank you, Lee. So write 3.8% if you have a high yield. If you don't, write 0.07%. Under policy, write 3.25%. And you can make a little star and put G1. No one's ever mad at us, when you're dealing with helping people set up their specially engineered whole life, because you get 2 guarantees. Here's one of them. A guaranteed contractual rate. Now they're different. They vary from company to company. But the example we're using today is one of the carriers we work with, which is 3.25%. Under bank, Lee, who is a good participant sharing with us today, gets 3.8%. Well, Lee, that is all taxable income. All that growth is taxable. Under policy, wouldn't you rather have it be tax-free loans, tax-free growth, tax-free distribution? It's a pretty good deal, tax-free. Under bank, you have unstable. What do I mean by unstable? Unstable, not stable. I've said this so many times, I obviously don't care about my grammar here. You guys pick. You guys are English people. Pick what you like. Unstable, not stable. Write what you want. But what I mean is think about the Silicon Valley Bank, right? Beginning of 2023, $204 billion, second biggest failure in the 2000s as far as banking goes. Then you have the Signature Bank, over $100 billion within the same month. That's $300 billion of bankrupt financial banks in a short period of time. Then you had a bunch of other banks in New York later that year in 2023, banks in the Midwest. If you go back to the housing bubble crisis of 2008, 2009, 364 banks failed. Guess how many insurance companies in that 2-year period? 0. So then on the policy side, right, stable. They've been profitable every year. This example, 148 consecutive years since 1877. Is that impressive? That impresses me. 148 years. The only companies that have been around this long that I have found when I did this research were breweries. Makes sense, right? And the mutually owned dividend paying whole life companies. So 148 years stable because they practice a different economy. They practice what's called Austrian economics, which means that it's sound money. The money has to be backed by something to use the money. It's non-inflationary. Imagine that. Under bank, it is unprotected. So if you have a business, how many entrepreneurs do we have here? Give me some eyes in the chat. If you're watching, you're an entrepreneur, imagine someone gets hurt, on the job or on a property, and they need money. And they are going to do what? We live in a sue-happy society they're going to sue you, right? And they're going to be able to get your money if it's in a regular old bank because of judgments and liens. Now, in a policy, it's protected against liens and judgment in every state. Now, some states aren't fully protected, but I can tell you great states like Florida, Texas, the majority of states, 37, are fully protected, and the other ones are protected more than the bank. So if we pause right here and look at your chart so far, look at the left side, look at the right side, and you're thinking to yourself, okay, well, if I'm using something for my living, for my life, I definitely want something that's going to be guaranteed growth. That sounds good. I want to be tax-free growth. I don't want Uncle Sam being my partner here. I want it to be in a stable environment where I don't have to worry about failures and bankruptcies. And I want to be protected against liens and judgments, from the law, somebody else that could take my money, a lawyer. And I want it to be accessible, not locked up in financial prison. Well, so far, everything on the right checks good. Everything on the left checks not as good, suboptimal, right? Well, now, under bank, if you have your money in a bank, if you leave whatever money you're saving there, I'm not picking on you, just happen to share with me, you don't have a death benefit. If you use the money's used for whatever that you've purchased. Under policy, you have a tax-free estate, a guaranteed legacy. And if people tell you can't buy your legacy, that's just not true. My family is 8 times more protected now than when I started this journey a little over 4+ years ago. 8 times more protected with guaranteed death benefit, guaranteed legacy from my 2 boys, from my beautiful wife that a lot of you already know. It's guaranteed. So if we're all on a board of directors at a bank, imagine sitting there and someone's asking you as a board member, hey, Miss Mark or Kim Baird or Juan, where should we store our money, our tier 1 money, which in bank language just means your safe money, your stable money, your money that has to be protected. Where do we store this money? On the left side or the right side? Well, if you're just using your common sense, remember this is an exercise of logic, you're going to put it on the right side. Well, banks know this. They've quadrupled, they 4x the amount of whole life that they've bought, which is bank-owned life insurance since 2013. They have over 225 billion dollars in specially engineered whole life. This is why there's so many executives, so many VPs at a bank. And Juan has already given away some of the future of this. So we're going to show you how the banks use your money to make money, but they're storing their money in a policy. Just think about that. Banks keep their money in a policy, not the bank. Doesn't that tell you enough about what you should do? So let's look at this. How does money flow? And Lee, I'm going to keep using you. All right, you've got your money in a high yield. So Lee's been saving for this new car. And they're super excited to get this vehicle. They've been saving, they have discipline, they're coming, and they're depositing money, they're paying themselves first. Lee's paying himself first or herself first. I'm not sure, Lee, man or woman, but you're paying yourself first and you're earning 4% in my bank, right? You're earning 3.8%, but I was more generous last year when you opened your account. Now it just went down a little bit, but it's still okay. It'll still work. But you come in to see me, and this is an exercise I want you to use. Like, am I telling you the truth as Jason the banker? And just pop it in the chat once you hear this scenario. Am I telling the truth? This is a game of truth or not truth, I guess. So 25,000 at 4%. You want to buy a $25,000 vehicle. You just missed that new car smell. And I say, hey, hold on there, Lee. Don't pull your money out of the bank. Don't interrupt the 4% you're earning. Instead, let me give you a loan at 6%. But it'll be all right. You're going to make money still at the end of 60 months or 5 years. Am I telling you the truth? Yes or no? You're earning at 4%. You're borrowing at 6%. Am I telling you the truth? Kim says yes. Kim, trust me. I like this. Kim, thank you. And the answer is yes, but most people are going to say no when they see this. This took me 19 times to get, y'all. So if it takes you more than once, just give yourself some patience. But look at the car side. You're making the monthly payments of $483.32. The future value is $28,990. Now, on the other side, the future value of the growth of the money, if you don't interrupt the compounding, is $30,525. I don't know math in the rest of the country, but us here in Florida, we know that 30,000 is more than 29,000. And you can even do this at a earning at 3%, you would still make money. And the longer you go out, so if you did this for 72 months, you do this for 100 months, you'll make more money because one is compounding and the other is, the mechanism is going down. Like the balance is going down with every payment you make. So this is already talking different about money. Now we're going to take $100,000. Lee's going to deposit the $100,000 into my bank again. Now we know, because of what I told you earlier, that this is a liability. But how do banks work? What do they do? Well, think about it. As soon as you deposit money in the bank, they have to move it. They have to keep that money in motion. So they lend it out to someone who's buying a home. Now they're going to lend, if they're paying us 4%, they're going to lend it at 7%. And then, well, someone's got to store that money, the seller, so they bring it back to the bank. And the bank turns around and lends it out again. Now someone's buying a new BMW. And they lend it out at 8% this time because it's a shorter period of time, more risk. So they're going to charge a little bit more, 8%. And the car dealer or the person that sold the car brings the money back to the bank. And the bank turns around and does what? They lend it out again. You know, your spouse wants a new kitchen, a new mudroom, maybe a new pool, right? So you do a home remodel. And now that's a little bit higher. So now they're charging you 9% to use their money again. But whose money is it in the first place? Yours. You deposited it there, right? Now the contractor brings it back and they lend it out again with a debt consolidation. And they're charging 12% this time. How much risk has the bank really taken on? In all of these first four scenarios, right? Our first three scenarios, they have an asset. They have the home, right? If you don't pay your mortgage, will you continue living in that home? No, they're going to foreclose on you. If you don't pay the car, then you'll get it repoed. I'm talking to a repo guy tonight, and he's the nicest guy ever. You never think he's a repo guy, but I'm helping them get started later today. Then you have a home remodel, okay? So in all these scenarios, the bank has leverage and they're making money on your money. Let's look how much money are they making. 7 minus 4 is 3, right? And then you have 8 minus 4 is 4. Gonna kind of go a little faster here. 9 minus 4, 5. And 12 minus 4 is 8. Let's go. And so let's add these up and you get what? You get 20. And they're paying you 4%. Well, okay, so you're making 4%, but they're making 20% on the money you're storing there. Wouldn't you guys like to put your names in the middle here and be the bank? So how much more of a percentage is the bank making? Is it 16%? No. Isn't 25 times more than 4%? Yes. The banks are making 500% on Lee's deposits to my bank. And if you guys look this up, again, check everything I'm telling you. Make sure you go out and research. Think for yourself. Really dig into this stuff. You know, poke as many holes in it as you can. But you'll find if you go to BauerFinancial.com that banks make between 400 and 1,300% annually on the money you leave there. Tell me that's not crazy. Tell me that's not crazy. That is a lot of money that they're making on us. So why not learn how to become the banking system in your life? Why not learn what they're doing? Instead of being mad at them, which you're probably going to feel a little upset, why not just model what they're doing? And at the end, you can schedule a call with me and you can learn more about this. You can schedule a call below if you're watching this replay. So remember, it's all about changing the one thing. Where does your surplus money go first? How do you pay yourself, create a privatized banking system, bringing it back to the you and me level so you take charge of this financial scenario?
You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you've felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up.
So let's look at this. I'm going to go a little quicker through this one, but let's look at our annual patterns of spending. Remember how I told you earlier that you finance everything you buy? Hopefully you wrote that down. You're either paying interest, earning interest, or giving up the opportunity to earn interest when you pay cash. So banks are super smart. They know how we spend money. They know our patterns. They know our nature. Now, for every automobile, we pay about 20 cents of every dollar towards our cars. From having thousands upon thousands of calls, strategy calls about your money, I can tell you a lot of people are paying more than 20 cents of every dollar. The housing, the next 30 cents of every dollar. Everything else, which is lifestyle, 40 cents of every dollar. The savings, 10 cents of every dollar. Now, actual savings right now in America are less than 4%, I believe. So we're being super generous. We're saying that, hey, the average American is saving. And by the way, none of you are average, so I know this isn't about you, but just look what happens about how much interest we're paying and what it would look like if we took back the banking function. That's what this is trying to show you. So we're saving 10 cents. Of the car, 5 cents of every dollar is interest. So what happens when we take over the car note, when we pay it off through our system, which I'll show you guys later? Well, we bring 5 more cents to our savings, back to our family. The goal is to take it away from the Ford family, from the Hyundai family, from whatever car make you have, you're financing it, and finance it through your system. Next, your housing. You have 25 cents of every dollar. If you guys have moved into your home or bought a home in the last 5 to 7 years, please do not go look at your mortgage statement. You will not like me, because you're paying 70 to 80% of your payment is going towards interest only. So now we're going to move that 25 cents over. So now you're up to 40 cents of every dollar. Like, the question really is, who here wants a 35% raise? Anybody? And then everything else, 5%. Probably more than that, because we're financing some of that in our life, right? So you're probably paying more than 5% additional interest. But look, just that shift alone brought, from this one exercise, 45 cents of every dollar you're now saving. So over time, with a little bit of patience and understanding, when you apply this, how many of you want to bring back 35 cents of every dollar to your bank, to yourself, to your family, to your wheel of wealth? Anybody? Lee says, sure. That's not a very excited sure. I would think that'd be all capital letters. Like, yes, I want to stop giving away all this money to other people. It's really like with taxes, it's about how much can we keep. So you guys want to know how you can get all the money back for every car or truck you'll ever buy, drive, and own? You guys want to see how this works? So let's dive in, pick up the hood, look underneath it, and show you how this works. Now we're going to do some crazy stuff here. We're going to do some things here I would never advise. I would never mentor you to do this, but we want to use it for illustrative purposes. So when we talk about the money that we're putting into our system, we're going to call it premium deposits, because that's what you're doing. Like when you get paid, your company probably makes a direct deposit into your account. So instead of calling them premiums, we're going to help switch the mindset, and we're going to call them premium deposits. And your age doesn't matter. The only big difference will be whether you're 20, 40, or 60 is what the final death benefit will be for the same amount of money. But as long as you have the equal health, good health, your age doesn't matter when it comes to banking. And I already mentioned the death benefit. It is not important, but I'm telling you, if you're here, it's because you love somebody or you love something or a cause. So to me, it's very important. It's under talked about, but we're not going to talk about it in this example. So let's look. Remember our example about buying the $25,000 car earlier? So how are we going to do this? We're going to pay ourselves first. That's the first thing we're going to do. We're going to make this premium deposit. We're going to assume that this person's making $100,000 a year and they're able to save $10,000 a year. They're already saving it somewhere else and they just redirected it into their account. So they make the deposits in years 1, 2, 3, 4, 5, 6, and 7. And in year 3, they're going to take a loan for $25,000. They're going to go buy the car, and now they're going to be an honest banker. They're not going to steal the peas. We're always going to teach you to be an honest banker, and they're going to pay themselves $500 a month. Are you guys following so far? So now you've had the Sally Saver mode. You've saved up for 3 years because you knew you were going to need a new car. Your car was a beater, it was paid for. But now instead of going out and financing it, you've put the money away, you've saved money over a period of time, and now you're paying the money back to yourself. So now you're paying that car payment. It was $483 an example. We just rounded it up $17. So you're paying $6,000 back to yourself annually. Now you can pick how you want to pay yourself back. Maybe you put it all in at once. Maybe you had a bonus or something. Maybe you paid it back at $500 a month. But no matter what, you were an honest banker. That's the point. So now your outlay over the first 7 years, 70,000 deposits, $30,000 for the things that you financed through your banking system, and you took a $25,000 loan. And so you would think that you, right, didn't earn or keep earning money on the money, but look, your cash value has risen to $67,000, even though you've only contributed 75,000, right? So you've got 91 cents of every dollar back. But wait, it's going to get better. After this 5-year period, now your kids have dropped shakes and fries and made a mess, mud. Your car's a mess. It doesn't smell new anymore, and you want the new car smell again. So now you come back and you decide in year 8, you're not going to make any more deposits. This is the crazy part, but you don't have to keep making deposits if you don't want to. Never recommend it, but let's look what happens. You buy another car, you take a loan for the $25,000. You're an honest banker, car purchaser again, you pay your system back. Now, you've only put another $30,000 into your account, correct? Because you've paid yourself back. You've paid back the loan from that the insurance company gave you, that you borrowed their money. And you paid it back with a little bit of interest. So you borrowed 25 and you paid 30,000 back. So you've only injected another $5,000 net, but look, your cash value still grew to $23,592 from that, what it was in year 7. So let's look at the 3 rules here. Does this make sense to you guys so far? If it doesn't, go back and watch it again. Remember that it doesn't make sense yet, ... So the 3 rules. Pay yourself first. I'm harping on this. Change that one thing as if your life depended on it, because your financial life actually does. Pay yourself first. Pay yourself with interest. Don't steal the peas. If the bank's charging, or, bankrate.com or the local dealership that you're buying from is paying or charging 8%, pay yourself 8% or more. Pay yourself with interest. Don't just pay yourself less because it's your bank. And then you want to recycle and recapture the money, meaning make the payments back to yourself so you can use it again. You're recycling the money because you're going to need it for other financing things in your life. So if this works for a car, what else can it work for? Anything, right? You're only limited by your thinking. You're only limited by your thinking. So let's look at this real world example of one of our clients. He saw this very presentation and he came up to the booth afterwards and he asked Chris Naugle, he said, "Hey, Chris, these are my debts. Can you guys help me?" And we said, "It depends." And we said, "Okay, show us what we're working with." And he showed us these debts. And we asked him, "Well, how much money are you putting into your qualified plan?" And he said, "Well, I put away $25,000 a year." And we said, "Okay, great. Would you be willing to change where that money goes? You don't have to work any harder, any longer, see any more patients," right? He's a chiropractor from Minnesota. I won't use his name, but he said, "Yeah, if it helps me get out of debt faster," because look, if he just kept paying it this way, $5,777 a month, almost $70,000 a year, it would have taken him 19 years. And so we showed him. So let's just change where that $25,000 is going. Let's pay yourself first. And so we started a policy. In year 1, he puts in the initial deposit, premium deposit of $25,000. He's got a cash value in the first 30 days of $14,000 plus, almost 15 grand. What's he going to do? He's going to take back control of those debts. Pays off Discover, pays off Lowe's, pays down and reduces the payment from Nordstrom. He recaptures $448 a month coming back to his system. Okay. Next year, makes the same deposit and watch what happens. Deposits 25,000 and look, his cash value goes up. He's paid that 5,000 and change back to himself for a total of 21,000. So now, and all he's doing this once a year, right? He's making minimum payments on these other things. And now he's going to pay off Nordstrom, Wells Fargo, and the private loan, probably a home remodel or a kitchen remodel on the condo. And now he's recaptured $1,917, almost 24 grand a year. And we're only in year 2, folks. It's pretty exciting, right? And then year 3, you deposit 25,000, and then look, already you're at the efficiency point where every dollar you're putting in gives you more than a dollar. So now you have 25,541. So you have an extra $541 that you can take as a loan. You paid yourself back 23 grand, and now he's got 48,000 in cash. Look, he's going to pay off the BMW and the boat for the condo, right? We're only in year 3. He's already recaptured $3,677 a month. But remember, this is not a get rich, fix your problems quick. Now, if you have the means and we just have to redirect it, yes, one of the questions in the chat was, hey, I don't have $10,000 I'm saving. Okay, well then figure out what you are saving and make it 10 to 20% of whatever you're earning. You know, sometimes we say 10 times your age, unless you're 60 or older, then it's 15 times your age. But I'd recommend look at what you're trying to solve, look how much you're paying yourself, and slowly over time, make the shifts, the adjustment, the pattern interrupts to pay yourself more. And again, I recommend somewhere between 10 and 20% of what you earn, your gross income, should go to you before it goes to Uncle Sam, before it goes to neighbors, before it goes to other people. If you have trouble remembering this, just think about the first 2 commandments. Love God, heart, mind, and soul, number 1. Number 2, love thy neighbor like thyself, which means that 1 is God, 2 is self, 3 is neighbor. So don't do what we showed you the common American was doing, which is going 1, 3, 2. Exactly what this chiropractor was doing. And all we're doing is over time, we are shifting where the money goes first. He's paying himself first. He's building guaranteed compound interest. He's borrowing from the middle tank, right? Which is a part I was going to add for the presentation today, which is the insurance company's money. So he's saving in one hand, he's spending in the middle hand, and he's guaranteed protecting his family in the other hand. So far, let's do a recount. We've put in 75 grand, and what are the loans, right? Every year they go up a little bit too. How much is left in the policy? Any guesses? $20,000? No. All 75,000 is still earning a guaranteed compounding interest. And Juan, yes, this will be in the replay in Chris's channel. I think it'll be out there on Saturday. And you can always ask me at the end. I'll give you a way that you can go and get this replay and schedule a call with me as well. Let's look at year 4. You deposit 25,000, the cash value's gone up again. You paid yourself back 44,000. This doctor did, this chiro did. And remember, you can add more zeros if you have more debt and you make more. You can add less zeros if you have less debt. It's all specific to you. This is specially engineered for you, but we're just using this real client example to show you what's possible. So now year 5, deposits 25,000, goes up a little bit more. Now he pays off the condo, pays down the home, and we're not even showing you the home payment change, right? Because you're probably paying the same amount there. It hasn't lowered it. Year 6, by year 6, basically he's gone to the point where here's my 12-ounce coffee mug. Can you fit 14 ounces of water into this mug? If you answer yes, it's probably not the right thing for you anyhow. But if you answer no, which I know all of you did, then it's time to start a new banking facility, a new warehouse of wealth, a bank on 3rd Street. So this is what the doc does. He puts 10 grand in, has cash value of 13,000 in the first policy, starts a second policy, has the same cash value as before, just to keep it simple. And now he's paid back 54,000 back to himself. That's just 4,556 times 12. Total cash, 82,000. Guess what? That's more than 76,000. Pays off the house. And in 6 years, not 19, remember the year before, or what the number was before, he's recaptured all of that money. Now it even gets better. We used to, once you had a policy in force, meaning you got approved to be an owner with a mutually owned dividend paying whole life company, once your policy is in force, meaning you funded it and it's in force, we would introduce you, and we still do, to your implementation team, and they're going to be your student drivers. They show you how to take a loan out, how to pay back a loan, and this is all complimentary. We do this because we aren't successful unless you are successful. But we added a step. After you do your paramedical, after you go through that underwriting part of the process, we will, if you have debt's your focus, and somebody say, hey, Jason, I don't have debt. Great. You still have to finance things. But if you have debt, wouldn't it be nice to know how long it would take to pay off all your debt, like I just showed you, based on what you're contributing? Wouldn't it be nice to know how much interest you saved? And wouldn't it be awesome to know how long it would take to recapitalize your system? Well, we'll provide that with this Debt Blaster tool. And then we'll also, if you need an additional meeting about it, we'll give you a debt map. So since we said we're going to show you how to map out the millionaire mystery, and that is my promise here, I want you to answer this question. How do you eat an elephant? You guys know? I used to ask this all the time back in my recruiting days. You do it one bite at the time. And the man or the woman at the top of the mountain didn't just fall there, right? They had to take steps. And as my wife Patty always tells me, hey, Jason, sometimes I get ahead of myself with the growth and the impact we want to cause and the people we want to help. And she says, remember, you're not going to start eating the elephant from his ears. Let's start from the feet. Let's start from the bottom up. Let's have elephant steaks, elephant stew. Let's get creative and have elephant hamburgers or whatever. And I'm not going to eat an elephant. No elephants were harmed here today or anytime in any of these presentations. But the point being is you have to start somewhere. You have to start somewhere. So wherever you're at, you know, whether you have a policy or multiple policies, or you haven't started, or you're not paying yourself, that is the note that I want you to make right now. Pick where you are right now and make a commitment to yourself, not to me, not to Jason, to you, to yourself. And let's look at this. Is it possible to owe no man or no woman nothing? Yes, it works for debts, expenses, vacations, homes, taxes, tuition, everything. You're only limited by your thinking. So it gets better. Again, I've said this a couple times. If we are the honest bankers, which I know everyone here is honest, we're going to keep paying back the condo for the 251 months and the house for the 224 months. And look, that's an additional almost $500,000 right there. Now, remember, if we put it into our system first, it's also earning us a guaranteed interest rate and probably more than 4% total, right? With the dividends never being missed, not guaranteed, but right there, you're at $750,000. And all we've changed is where the extra money was going first. Is that not wild? For real? It's crazy. So now that you know this, everyone should do it. If you're not, I'm sorry, you're stealing from your kids, from your grandkids, from your future, because now you know better. Even if you're not there yet, you do know. Once you see this, my hallucination is you can't unsee it. So like Warren Buffett said, if poor people would just do what rich people do, they wouldn't be poor anymore. Isn't that the truth? And a lot of that comes with our money rules, our money conversations with ourselves and how we feel about money. But Warren nailed it on the head. So there's only one of two things that's going to happen to all of us here. I already gave this away earlier, but we're either going to live or we're going to die. In either scenario, since we finance everything we buy, right? And one day we are going to graduate, are we better or not with or without this? So by asking yourself these powerful questions and really listening to your heart, you're going to find your path. Wherever you're at today, just give yourself permission. If you don't know this, if you're not practicing, you have a decision to make. Are you going to schedule a call with me? Are you going to learn more and then schedule a call? Or are you going to ignore all this and just know this and be someone who comes in the call and tells me, hey, I've been watching this for 10 years. It's a little bit mean. And I know everything about infinite banking. I watch all Chris's videos, all your videos, Jason. I've read Nelson's book. I've read What Would the Rockefellers Do? I've read Unshackled. I've read Banking on Yourself. But if you haven't started, if you haven't gotten the mat, the reality is you don't know anything. You have to get on the mat. You have to take action to really learn. And we're here to make sure you don't make mistakes, to make sure it's specially engineered for you based on your problem, meeting you where you're at, and we're giving you the tools and the team to guide you. So again, if you want to learn more, if you want to watch the replay, please do. Give yourself permission. I'm super blessed that you have just given me your most valuable asset, your time, your energy, your focus. Let me know if you have additional questions. Again, super blessed to have all of you here. So go ahead and schedule a call with me. If you're looking to learn more, if you have questions, bring those questions to the call, or just be around the campfire. Keep learning with us. We're here to support you. As always, God bless, be blessed, keep learning, keep investing in yourself. Your most valuable real estate is that 6 to 8 inches between your ears, everyone. So have a blessed day. Until next time, I'll see you then.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.